Palantir is growing extremely fast. Apple is still one of the strongest businesses in the world, but today I wouldn't buy either of them. Oracle was different. After my analysis, I decided the price was attractive enough, so I bought the stock. With Oracle, the biggest question is free cash flow. So in this video, I'll show you what I found in Palantir, Apple and Oracle after their latest results, what my fair value models say, and why only one of these stocks was attractive enough for me to buy. Let's start with Palantir. My problem with Palantir isn't the business. The business is exceptional. Palantir sells software that helps companies and governments use large amounts of data to make better decisions. AI is now becoming a much bigger part of that software. In the latest quarter, revenue grew by 93% and US commercial revenue grew by 149%. Based on the current guidance, full year revenue could grow by around 82% in fiscal 2026. With growth like that, you might expect my valuation to be close to the current stock price. It isn't. Palantir trades at around $172. My fair value today is around $105. Even my aggressive bull case is only around $155. And only a very optimistic case gets close to today's price. And the strength isn't limited to the commercial business. US government revenue also grew by around 90% and adjusted operating margin was above 60%. So what does a price of $172 already require from Palantir? Using my normal return assumption, Palantir needs roughly 30% annual revenue growth for another 10 years to justify today's price. And that's not 30% next year, it's roughly 30% every year for another decade. Palantir may keep surprising investors, but the stock doesn't need the business to fail to disappoint. Growth only has to be lower than what today's price already expects. And at this valuation, that leaves very little room for mistakes. Oracle is a useful reminder here. When Oracle traded close to $346 in September 2025, some analyst targets also moved into the $350 to $375 range. Then the stock fell sharply. I'm not saying Palantir will do the same. My point is that analyst targets often move higher when the market gets more optimistic. That's why I care more about what today's price requires from the actual business. For now, Palantir stays on my watch list. I just need a much better price. Of these three companies, Apple is probably the one I would feel most comfortable owning for the next 10 or 20 years. But I still don't like the stock at today's price. Apple trades at around $304. My fair value today is around $220. My 12 months base target is around $235. And my bull fair value is around $345. So unlike Palantir, Apple's current price can fit inside my bull case. The question is whether I want to pay today for that much future success. Apple still gets most of its revenue from hardware, but the investment story is much bigger than just selling iPhones. Apple also keeps earning money after the device is sold. Services like App Store, iCloud, Apple Music and other subscriptions generated around $31 billion in the latest quarter. That makes the business more stable because Apple can keep earning from the same customer for years. Apple also uses a lot of its cash to buy back shares. When a company buys back shares, the total number of shares can become smaller. That means each remaining share represents a slightly larger part of the company. But buybacks work better when the stock is cheaper. At a higher price, the same amount of money buys back fewer shares. Apple's cash flows are also more stable and easier for me to estimate than Palantir's or Oracle's. That is the one reason I'm comfortable using a lower required return for Apple than I would for many other companies. In my base case, I already assume roughly 7% annual revenue growth over the long term. That gives me a fair value of around $220. My bull case assumes stronger growth, around 9%, and gets me to roughly $345. But I also looked at the valuation in reverse. At a price of around $304, Apple would need roughly 12% annual revenue growth through 2035 if I keep my normal base return assumption. Is that impossible? No. Apple may absolutely grow that fast for some time, but maintaining something close to 12% growth for almost a decade would be a very strong result for a company already as large as Apple. There is another way to justify the current price. I could lower my required return to around 7.2%. 10%. But that would mean accepting a much lower return for owning the stock. So I don't think Apple at $304 is crazy. I just don't think the price gives me enough room if the future is only good instead of excellent. There is a Howard Marks line I really like. It's not what you buy, it's what you pay that counts. That line is exactly how I look at Apple today. I really like this business, but that doesn't mean I want to buy it at $304. It's very easy to say, it's Apple, just buy it. I don't want to invest that way. Below roughly $235, Apple starts becoming more interesting to me. Around $200 to $220, I would be much more comfortable buying. And below roughly $180, the margin of safety would become very attractive to me. So Apple stays on my watch list. I'm waiting for a better entry. Oracle gave me a very different result. This time the gap between the stock price and my valuation was large enough for me to buy shares. I showed the real purchase in my latest public portfolio update. Oracle has been known for databases for decades. Today, one of the most important parts of the story is cloud infrastructure. In simple words, companies can rent computing power from Oracle instead of buying and running all the servers themselves. And AI needs enormous amount of computing power. That is why Oracle is spending so much money on data centers, servers and AI infrastructure. OCI, Oracle's cloud infrastructure business, reached around $18 billion for the year. But the number that matters even more for the future is around $638 billion in RPO. In simple words, Oracle already has contracts for a huge amount of future business. The revenue will come over time, but this gives us much more visibility in the future demand. That is why I don't think revenue growth is the hardest question with Oracle. The harder question is how much cash will be left after all this AI infrastructure is built. Oracle has to spend the money first. In fiscal 2026, capital spending jumped to around $56 billion. Free cash flow fell to around negative $24 billion. And Oracle plans to keep spending heavily as it builds more capacity. A company can grow revenue very quickly and still use a huge amount of cash if it has to build expensive infrastructure first. So I don't only want to see more cloud revenue, I want to see that investment eventually turn into free cash flow for shareholders. So after looking at all of this, why did I still buy the stocks? The price. Oracle trades at around $152. My fair value today is around $185 and my 12 months base target is around $200. At $152, I don't need the most optimistic case for the investment to work, but I also don't treat $185 as some guaranteed value. Oracle still has to deliver. My base valuation depends on strong revenue growth and today's enormous investment eventually turning into much stronger free cash flow. And if I demand a higher return because of the risk, the valuation falls quickly. At a 9.5% required return, I get around $174. At 10%, I get around $157. That last number is important. Even with a stricter 10% required return, my valuation is still close to today's market price. That is the one reason I was comfortable buying Oracle. At today's price, the potential upside is large enough for the risk I am taking. Now I want to see the free cash flow follow the revenue growth. If Oracle delivers and the valuation stays attractive, I can continue building the position step by step. And this is the one of the stocks I'll keep updating after future earnings. So today Oracle is only one of these three that I am willing to own at the current price. Palantir may be growing faster than almost anything else I follow, but at $172 I need a much better price. Apple is a company I would be comfortable owning for many years, but at $304 the market is already asking me to pay for a very strong future. Oracle has more uncertainty, but at $152 I think the price gives me enough upside to accept that uncertainty. I don't need every great company in my portfolio today. Sometimes waiting is part of the strategy. And I am really interested if you agree with me or not. Would you buy any of these three at today's prices? Tell me which one and why. Write your answer in the comments, I'll reply to everyone and we can discuss it there. I update my fair value models with new earnings reports. So if you want to see when Apple or Palantir gets close enough for me to buy and whether I add more Oracle, subscribe for the next updates. And if you want to see what I actually do with my own money, follow the public portfolio videos. Every real portfolio change will be there. Study investing, apply what you learn and grow your capital. And always remember that we are here to make money. Everything else is just poetry. I am DP and this is Durable Profit.